Welcome to the world of property investing, the land where dreams can either come to life or be crushed. Sounds scary, but also wonderful, doesn't it? Well, as a property investor, you need a portfolio. Shocking news. A portfolio will speak for itself in terms of how skilled you are as an investor. You want your portfolio to stand out from the crowd so you can have a multitude of income streams coming in from different property strategies. That's where we all want to be. That's utopia in my world. Now you might be thinking, how's diversifying your portfolio going to benefit you? Property is a durable investment, but you must minimize the risk of a portfolio to earn a sustainable and consistent regular income. Luckily, because of its flexibility, you can build a diverse portfolio with just property. You will then reduce the impact of a roller coaster that is the market and the effect of any void periods, especially long sustained periods. And of course, the best part about diversification is that you have a multitude of income streams which you can reach your financial goal through. So how does one diversify their property portfolio? Well, you don't want to do what a certain streaming service is doing, not naming any names. Let's discuss one of the most common methods to diversify your portfolio, which is with different property types. You can go for a combo meal, which is mixing and matching with different sectors such as commercial and residential. Or you can go into one particular sector and opt for various properties that you find in that particular sector. You will discover that a specific demographic exists for every single type of property, and if you're in property, that should not be news to you whatsoever. Suppose you are a residential property owner who wants to diversify. You will then be thinking about houses and flats, I assume. Two very different demographics are interested in these kinds of properties, in my experience. The older generation and families are more likely to go for a house for obvious reasons, whereas a young professional would prefer to opt for a flat. To further diversify your diversification, you can kick it up a notch or two and invest in a mix of studio flats and apartments and 2-bedroom flats, and that helps you attract people who prefer flats, and it adds another layer of security because you can have a husband, wife, girlfriend, boyfriend, partner situation, and a 2-bedroom flat or apartment may work better for them. By going combo mode with a single portfolio type, you can be attractive to a wide range of tenants. But when I say you, I mean the property that you have. I'd love to make you more attractive if you want to be, but that's not my expertise, I'm afraid. It's like writing open to whatever on your Tinder profile. In the long scheme of things, you can save yourself from being brutally damaged by void periods, which you would be if you own just one property, or at least the risk exists and increases. To clarify, you don't have to cast them all the way to the very best like no one ever was, but you must make sure you have some variety, which is called diversification, by the way, if you haven't figured out so far. Even if you would rather stick to one specific type of property, you can still create a diverse portfolio, and that is important, and I think I've made that clear. You see, where a buy-to-let property is located can either make or break that particular investment, in my experience, and that means it's an invaluable technique for diversification. The last 16 months or so have been full of ups and downs in the property market, enough to make anyone sick, and I know it's made me sick a couple of times. Most of it was because of the changes in tenant demand and also the messing about with that mini budget that really screwed us all. For example, London used to be a beloved place for tenants, but now we are witnessing tenants opt for more of a rural location because they want a better quality of life, and I don't blame them whatsoever, having spent quite a bit of time in London myself. Perhaps the grass is greener on that side. Property owners who have buy-to-lets in London might have been affected by the shift in tenant demand and the void periods that followed. On the other hand, if they had properties all over the UK, then the loss could be balanced out by the rise in rural areas. So, no matter which type of property you choose, you can still reduce the risk of your portfolio by investing in different locations, even if it's within a reasonably tight gold mine area. And as a side note, you can invest in pockets of one specific location. It is super useful in my view if you know a local market very well and then plan to be loyal to it because it's going to serve you well. Yes, it is riskier and can be seen as more riskier than investing in various places due to density, but don't worry, certain postcodes perform better than others, resulting in excellent returns. Buying at different prices, okay, so far you know that type. Buying at different prices, okay, so far you know that different types of properties and their locations attract specific demographics. Another factor that comes into play is different values. A property that has a high price will generate more rent than an affordable property, and when you come to sell it, it's probably going to be an even higher price, because if it were in demand when you bought it, that demand will likely continue unless something radical happens, like an airport gets built close to it. But you'll know that through the planning process and also when you do the searches. And this means that such a property will attract more well-off tenants because you paid more for it, so it's in a better area. Before you jump right in and invest in a more costly property, it is better to think through the options available to you. Do not rush. Suppose you're considering in purchasing a flat that costs say £500,000. What you could do instead is buy two flats, one at £300,000 and another at £200,000, and voila! Not only is the risk of your portfolio reduced, but you can also benefit from a higher rental income because now you have two properties with two lots of tenants. If you invest in a mix of costly and affordable properties, you can maximize your portfolio through capital growth, but that's not the only thing you should be looking at. Regular cash flow is more important in my view. Okay, for this to work out well, you must invest in a good location. This way, the affordable properties can go through natural capital growth, while the more posh properties, if I use that phrase, can generate more rental income as you hold on tight to the ups and downs of the property market, because ups and downs we always have. By investing in a city that has potential for high capital growth and high average yields, you are on the express train to lucrative investments. May you arrive at your destination on time and with your pockets full. Whichever path you decide to take to diversify your portfolio, the important thing is you must diversify, in my opinion. Perhaps you will choose all three. You can benefit from multiple streams of income, reduced impact of capital fluctuations, and a steady way to accomplish your financial goals. What more do you need? And that's all I have time for, in fact, today. Come back later and I'll tell you how to make your Tinder profile more attractive, even though I have zero experience. And before you leave a comment below and share your thoughts.